So with the trust, you can partner with the trust to buy more property. You can partner with the trust to build property.
Now explain, how does the 1031 differ from the Deferred Sales Trust, the
So all of
DST?
the great things about 1031, there's also some downsides. You have to do it. You have to identify something within 45 days, and you have to buy something within 180 days of you selling your down leg or the property that you sold. Okay, and you have to put it into another property. But our parents taught us to sell high and buy low, Gabe. They didn't teach us to sell high and buy higher 180 days later. And too often people are in what's called the 1031 shotgun wedding. We've all been there, Gabe, or at least had our friends who married the people they shouldn't have married because they got married really fast and really fast. You're like, whoa, that's moving quick. Well, that's like the shotgun 1031. And too often people get completely wiped out, and people are going to get wiped out in 2023, I believe, who had overpaid in 2022 and 2021 via the 1031 exchange because they felt they had no other alternative. And what wipes people out? Too much debt, not enough liquidity, and not buying on the intrinsic value of the property, not having a value add opportunity, the property already being maxed out in rents, right? And so I had a client in 2007, was at Marcus & Millichap. He owned $50 million of C-class properties. He was leveraged 70, 80%. We told him to get out. Now, at the time, we didn't know about the Deferred Sales Trust, but we just told him, you should get out of these properties that are a little bit questionable. You have a lot of debt. He goes, I'm trapped. He goes, because if I sell, I have to overpay for a property. I have to do the 1031 and I have to replace my debt. Fast forward, his entire house of cards fell. He had $50 million worth of real estate, beautiful $3 million house. He lost his house. He lost all of his real estate. He went bankrupt. And we're going, the 1031 exchange was not his friend. He had just been exchanging up until everything stopped. Now, do we think the 08 crisis is going to happen like that? No. And did most multifamilies during the 08 crisis, if you didn't over leverage, as you do find, yes, if you had a chance to hold on. But the concept of this is, had he known about the Deferred Sales Trust, he would have sold high, paid off all of his debt, diversified the wealth into, you could put it into U.S. Treasury bills just to wait on the sidelines. You can put it into hard money lending. You can put it into passive real estate deals. You can put it into stocks, bonds, and mutual funds, but you can dollar cost average and you can take your time. So think of the Deferred Sales Trust as like a place where it's a safe harbor for your capital. It's a place to relax and wait to see where opportunities are going to come up. It's a place to diversify and pay off debt. In other words, it's more of a preservation play at first, but then it becomes a chance to pounce when the iron's hot, right? When there's opportunities. And so we believe there's opportunities coming. So with the trust, you can partner with the trust to buy more property. You can partner with the trust to build property. We had a client, he sold a $2.6 million business in Alabama. And that particular deal, he deferred hundreds of thousands of dollars of tax. And then he was building 70 multifamily units in Tennessee. So it became his capital partner to invest with him, all tax deferred without having to raise capital, get it from a bank. The trust was able to be that silent joint venture partner for him. So that's a cool way to go fund yourself, all tax deferred. We did another deal out of San Diego, about a $12 million deal, almost 13, 4 partners that were exiting. The 1031 exchange doesn't allow all the partners typically to exit. They have to all stay together. Well, with the Deferred Sales Trust, we can seamlessly separate the partners. Each can have their own trust, and they can defer the tax. These guys are also developers. They bought this land. It was just a taco stand. If anyone's ever been in San Diego, they have a lot of taco stands. Really good taco stand. But it was just like in a kind of a rundown neighborhood. Yeah, kind of a rundown neighborhood. And they built this this car wash. If you're watching this on YouTube, you can see
it's a car wash. I thought that said Orange Theory. Okay.
Yeah, car wash. And then they put the taco stand inside of the car wash while people get in the car. And so the guy's business like tripled, right? So like it was a deal for him. And then they built the car wash, and so $4 million all in, about a $12.7 million exit.
Wow.
Huge tax. And they found us 21 days before they exited. They were like, we're not doing a 1031 because we're not in the business of buying $13 million pieces of land. We're in the business of buying land for $500,000, building on it for $4 million, $3 million, $4 million, and then selling it for 13. And so just the simple business model for a 1031 exchange puts you in a weird position. With the Deferred Sales Trust, you have like really total freedom and flexibility.